Hi, this is Phil Town for Rule 1 Investing. We're going to talk about the all-important, super critical cash flow statement. All right, there are, just as a reminder, 3 financial statements that are all important, and all of them show us different pictures of the company. Now, if you want to learn to be an investor, you've got to learn to, speak investorese, or whatever you'd say, right? Investorese. So the language of investing, the language of business, is found in these 3 financial statements: the balance sheet, the income statement, and the cash flow statement. Now, cash flow statement is used to determine if the company we're researching is healthy. That's what we want to understand from the cash flow statement. Is it healthy from this very important point of view? Do you have the cash coming through so that you don't run out of money? That's the critical aspect of the cash flow statement. Earnings statement tell you if you're profitable. The balance sheet tells you that you have a company that's worth more than what you owe. And the cash flow statement is there to show you that the cash is available for you to function. So the cash flow statement is kind of like looking at the gas gauge on your car, right? Do you still have gas in the car? Now, when you look at the cash flow statement, there are some pretty big red flags that jump out at you. When you see the cash flow statement, right on the top line of it, it's going to say net income, and you're going to get a number from the income statement that's the same on both of those 2 statements. So the cash flow statement takes the net income from the income statement, and it begins the cash flow statement with it. And what that does is it says, okay, we've got this net income, this gap accounting, this sort of fictional number of how much money we made. Let's turn that into real dollars and see if that's what we've actually got in the bank. So the first big red flag to work for when we're looking at a cash flow statement is you go down to the first big major bold section of it, which is operating cash flow or cash flow from operations, and it's a smaller number than the net income. Or a real red flag is it's negative number. That means you're losing cash as you're going forward, and that's a huge red flag. Now, another big red flag on a cash flow statement comes down to the last section, which is about financing cash. In other words, if you have gone out and borrowed money, that'll be in that 3rd section down there. And if you've gone out and raised money by selling stock, that'll be in there. Now, here's a red flag that really jumps out at me, like when I looked at a company like GM, and you see that they are paying dividends. So this is money paid out, and it's in that finance section of the cash flow. They're paying dividends, and you notice that they don't have the cash flow out of operating cash to pay the dividends. So where did they get the money? The dividends are flowing out to investors, but the money isn't coming from actual operations. Where's it coming from? And then you see that they're borrowing as much money as they're paying out in dividends. Holy smokes, gigantic red flag. Now, there's some gotchas out there that are beyond that, but those are 2 of the really big ones that you want to watch for. Now, let me give you a couple of examples of really good cash flow statements and really bad cash flow statements. I just mentioned GM. Take a look at rule number 1. My book that I wrote that got to the top of the bestseller list goes into this in the GM example, where GM was having a terrible time with cash flow and still paying out those dividends every year to kind of create a fraudulent experience for the investors. I mean, the investors are looking at this and going, hey, GM must be fine because I'm still getting my really nice dividend. When in fact, GM was borrowing money from over there someplace and may never be able to pay that loan back and go bankrupt in order to pay you your dividend. So you end up paying about $80 a share for this company to get your little dividend, and then the company goes broke. That's a horrible problem. And you would have seen that in the cash flow statement. Now, Apple Computer is exactly the opposite. They have huge cash flow, giant cash flow that comes in, cash flow that's way bigger even than their earnings. And so when you're looking at a company like Apple, you can put a value on it that's maybe larger than what it would expect to see from just earnings growth because it's so much cash. Microsoft, back in its heyday, same kind of thing. It was just growing cash like a maniac. So really good companies produce real good cash flow growth. And of course, at some point, that turns into free cash flow that can go in the pocket of the investors. Now, we love cash flow growth, and we love to see what that growth rate is. So one of the things we do with Rule 1 investing is we look at the cash flow growth, both in terms of operating cash flow and free cash flow, and we compare that to our growth rate on earnings and see if it's the same. If it's the same, mwah, lovely. We love that very much. And if they're the same, we can use that as a way of figuring out the value of the business down the road. So if you like what you've seen here, you guys, subscribe to my channel for more content. Teach you all about how the best investors in the world do this. I'm Phil Town. Time to go play.